What if I told you there was an ETF whose top holdings included Tesla, Apple, Amazon, and Facebook? And not only did it have an 11.6% dividend yield, but it paid those dividends monthly. Seems too good to be true, right? Well, that ETF exists, and its ticker symbol QYLD, the Global X Nasdaq 100 Covered Call ETF. And we're going to look at that in depth to find out if it's for real or if it's a bit too good to be true. How's it going, everybody? Welcome back to the channel. As always, my name is Jay. Because I don't change my name always stays the same. I don't know why I said that. But today we are looking at the QYLD ETF. I came across this ETF when I was researching some possible new investments for my $0 to $100,000 dividend portfolio I'm doing here on the channel. And I saw people talking about this, saying it has an 11.6% dividend yield. It pays dividends monthly. It just seems too good to be true. So I did some research on my own, and today we're going to look at the pros and cons of the QYLD ETF, whether or not that 11.6% dividend that QYLD pays is sustainable or not, and obviously, whether or not QYLD should have a place in your portfolio. Now, the official name of the QYLD ETF is the Global X Nasdaq 100 Covered Call ETF. So to look into ETF, we first have to take a little detour and understand what a covered call is. Now, a covered call is an options contract. Specifically, it's a contract to sell 100 shares of a specific stock at a specific price at a specific date sometime in the future. Now, when you sell this contract to someone else on the other end of it, you collect a small premium for writing that contract. This is a strategy used by a lot of people to generate more income on the stocks they hold in their portfolio. It's one of the relatively safer ways to use options in your trading strategies. Now, here's how the QYLD ETF works. The QYLD ETF tracks the Nasdaq 100 index. So what they do is they buy shares of all the stocks in the Nasdaq 100 index, just like any other index fund or index ETF out there would. So this means they're buying shares of Tesla and PayPal and Facebook and Google and all the rest. Then QYLD sells covered calls against these shares. These covered calls are at the money, meaning that the strike price for these calls is relatively close, if not exactly, the share price of the index at that time. And they're selling these contracts with an expiration date of 1 month out into the future. Obviously, QYLD holds a ton of shares of stock, so they're writing lots of these option contracts and collecting lots of premium on each of those options contracts they write. Then at the end of the month, depending on what happens with the index, they return as that 11.6% dividend to their investors a portion of those premiums they collected from writing the contracts or the proceeds of selling the underlying stocks on the contracts. Then they rinse and repeat the next month. So to better understand QYLD and how it works and if it's worth an investment in your portfolio, we have to look at how this covered call strategy works in different kinds of markets. So first, let's say the Nasdaq 100 stays flat. It doesn't move up or down much in any direction, and at the end of that month, the price of the index is still below the price they wrote the contracts for. In a flat market like that, the QYLD ETF will simply collect all the premiums on options contracts they wrote. None of those contracts will have to be exercised because it didn't reach the strike price, so they won't have to sell any of their underlying shares either. So that's pretty much the best case scenario. They're writing the contracts, nothing much happens, they're just collecting that income and passing it on back to you. But the Nasdaq 100 is kind of a volatile index. You can see from their top 10 holdings and some of the holdings I've mentioned they own a lot of the hot tech stocks in the market. Let's say the Nasdaq 100 index goes up fast. So we are in a hot rising market. In that scenario, the price of the index will rise above and beyond the strike price that QYLD wrote those option contracts for. When that happens, QYLD is going to have to sell the shares of the underlying stocks at the price they wrote those contracts for. So even though the index may have risen far above and beyond that strike price, they have to sell at that price, therefore missing out on any further gains. And in the third scenario, let's look at a bear market, a falling market. So the Nasdaq 100 falls from the initial price that we wrote our options contracts at. In this case, It's good for QYLD because they won't have to sell any of their underlying shares. They'll simply collect the premiums on the covered calls that they wrote, but they're still holding those underlying shares of stock. So as those shares of stock are falling, the value of the ETF is falling too. So some of the problems of the QYLD ETF are probably starting to become apparent to you now. When you're investing in QYLD based on the strategy it implements, with QYLD, you're limiting your upside in a rising market, but you're keeping all the downside risk in a bear market. The downside will have a little protection because of those options contracts premiums that you're collecting along the way, but you'll still be losing value. Let's see how this actually plays out for your overall returns and compare the QYLD ETF versus a couple other ETFs you may consider investing in. First, let's look at QYLD versus the ETF of its underlying index, the Nasdaq 100, which is ticker symbol QQQ. Here you can see when we're comparing QQQ and QYLD, QQQ is outperforming QYLD by over 31% over the past year. And if we expand that out over to a 5-year period, you can see you're losing out on over 150% of total returns, dividends included, by investing in QYLD versus its underlying index, which is the QQQ ETF. So what's happening when you're investing in QYLD is you're sacrificing almost all price appreciation in the name of receiving a giant dividend each month. And the next important factor to look at when considering any ETF or mutual fund is the expense ratio and the fees involved. Now, the fees on the QYLD ETF, it has an expense ratio of 0.6%. And while when we compare that to something like VTI or VOO, which are at 0.03%, it's a lot higher expense ratio than those, so a more apt comparison would be a more actively managed ETF. If we compare QYLD's expense ratios to something like the Buzz ETF, which I've talked about before, or the ARK-K ETF, it actually comes in under those. Those have an expense ratio of 0.75%, and QYLD is slightly less at 0.6. Another important thing to consider before investing in something like QYLD is the taxes. This is the document straight from the Global X website on the QYLD ETF, explaining how they calculate the taxes on their returns. And because QYLD invests in both stocks and options contracts, they use what's called a mixed straddle approach for their distributions and taxation purposes. I don't know what that means either, but let's just say taxes for QYLD are complicated. Thankfully, they do give us a little insight on how the taxes work in simple terms towards the end of this document. They say that in 2019, 85% of the distributions of QYLD were taxed as ordinary dividends or short-term capital gains. This means 85% of the distributions would be taxed as ordinary income. It'd be taxed at the same rate as your paycheck. 3% of the distributions would be treated as long-term capital gains. This means the tax rate on that 3% would be slightly lower. And 12% of the distributions of QYLD would be treated as a return of capital. When distributions are treated as a return of capital in an ETF or mutual fund, that means they're not taxed at all. There's some good and some bad there in how the tax situation with this ETF works. 12% of the returns, at least in 2019, were not taxed at all. 85% of the returns back to you were taxed at the ordinary income rate, which is going to be much higher than any other dividends or capital gains you'll likely receive. If you're finding all this information and research I've done on QYLD helpful, please leave a like on this video down below. It really does help me and the channel out, and I'd greatly appreciate it. Let's get to the reason we're all here. Should you invest in the QYLD ETF? Obviously, that's a very individual decision and not one I can answer for you specifically because I'm not your financial advisor and I can't give you personalized financial advice. But if you are going to invest in the QYLD ETF, you have to do so being okay with foregoing almost any and all gains in price appreciation in the name of a big fat monthly dividend check. In my humble opinion, the QYLD ETF is most suited for people in retirement or anyone else who finds themselves in a situation where they're looking to sustain themselves or live just off the income that their investments are producing, and they're not worried about necessarily growing their investment balance to the max it can be. So if that sounds like you, if that sounds like your situation, definitely check out the QYLD ETF. Because that 11.6% dividend payment isn't actually in the form of dividends, like in a stock or other ETFs, because it's generated from options premium, selling covered calls, it is sustainable. It will fluctuate, it won't be consistent, but you can generally count on getting a big dividend from this ETF every month because they'll be selling such a large volume of those options premiums. I hope you enjoyed this video. Let me know down below if you're going to invest in QYLD or not. Check out these two videos over here. Leave a like down below, subscribe to the channel, do all the things. I hope you enjoyed this, and I'll see you in the next one.